Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's August 3rd, 2023. It's a Thursday, and we got one of my favorite guests of all time coming on, and that's Ryan Detrick. As a chief market strategist over at Carson Group. You've probably heard of him. The guy does the rounds on financial media all the time. He's one of the few that I actually do not put on mute and listen to. One of the guys I follow on Twitter 24/7. He called the market bottom, him and his research team, in October, and it's been right since then. And he's calling for a little bit of a pullback here. However, very bullish long term. We're going to talk about the downgrade that Fitch gave the United States and what that truly means for stocks. All that more coming up right now on Making Money. Over 1 million people around the world follow Wall Street veteran Mark Chaikin for his shockingly accurate stock market predictions. He just gave them a dire warning. Mark says we're about to witness an historic stock market shakeup that can soon create devastating losses for investors who don't know what's coming. And as a result, you only have 90 days to move your money. You see, Mark spent 50 years on Wall Street at some of the most prestigious hedge funds in history. And he's been on Fox Business and CNBC countless times. But this is a financial story no one else is telling. And if you let this take you by surprise, you could be in for a world of pain. He explains everything in a brand new free report available at rollingcrash2023.com. He includes a name and ticker of a popular stock that could be directly impacted by what's happening as well. Mark warned of the beloved pet brand Chewy before it fell 45%. Tech company C Limited before it fell 66%. Furniture company Wayfair before it fell 76%. Social media favorite Snap before it fell 36%. And food delivery company DoorDash before it fell 65%. Mark even called the Amazon crash before the FANG stock fell 35%. So you'll want to avoid the stock in this new report immediately. Again, simply go to rollingcrash2023.com for your free copy of this new report. So here we are going to welcome back Ryan Detrick from Carson Group, Chief Market Strategist. You know, obviously, I've said this last time and I'll say it again. He's one of the guys, you wake up, I used to get coffee, Ryan. Now I get tea. And then, back in days to get the paper outside. Now I log into Twitter, and he's one of the first people I read every morning to catch up the last 24 hours, what he's put out. One of the must follows on Twitter. And what I love about it is you put it in charts. So even a dummy like me, Ryan, can understand what the heck you're trying to say about the market. So thanks so much for coming back on the show.
Yeah, what's Twitter, by the way? I thought it was called X.
Oh, sorry, X.
X,
right? Yeah.
I know. We're never going to get that. Yeah, I mean, I started using, it was Twitter back then, February of 2009, one of the first market strategists, market guys to leverage social media. I said, this is kind of stupid, but I did it anyway. Now I've got a lot of followers. I've got my last couple of jobs because of social media. But I'll just say this, what I learned was what you just said. People like charts, they like tables, they like looking at history to tell a story. And literally my career, the last 13, 14 years, has been doing just that. So it's amazing how things work. So, hey, Twitter has been good to me. It's called X now, but Twitter's been good to me.
Exactly. Yeah, and you've been good to the Twitter universe. I would say that too, because, again, and I don't say that stuff lightly. I'd say 98% of stuff that's on X is garbage. And so you need to really sift through and see, who's pushing agenda, who's actually just sharing great information, which you do. You put the information out, let the person decide. Here are the facts. You decide from there, what you want to do. So speaking of which, last time we had you on the show, you were bullish and you've been right. So the market's been, on a tear since the last time you've been on. So big picture, what's your view here now, Ryan?
Yeah, so we did come into this year bullish, like you said there, and I'll tell you, people hated it. It was just like you mentioned, Twitter. Look at any of the bullish tweets I've given since late October last year, and that was one of the reasons we were bullish. Also, didn't see a recession. Some of these big picture things, we saw a strong economy, strong consumer. Nobody was talking about that. Now you look at Bank of America; they're changing their tune. Lots of people changing their tune. So we are still overweight equities. Yes, after this run we've had, though, I'm looking around, realizing, a lot of people that were bears are saying, I'm sorry. Literally, Mike Wilson, I'm sorry. It does good stuff, and everybody makes mistakes. I get it, so I'm not judging there. But I'm just saying it feels a little different now. I hate to say this time is different. Four most dangerous words. But there's a lot of people all of a sudden catching on, and here we are in August, September, and everybody and their mothers pointing this out, so I'm aware of that. But these months can be a little troublesome, so we're still overweight. but we think maybe a 4 to 6% correction. And maybe we're going to use the excuse. We can talk about what Fitch did here. Maybe we use the excuse of the downgrade, why maybe some sellers take place, but we still think there's a pretty good sized bull market in front of us. It just might be time for a break because all of a sudden a lot of people are bullish and people are saying there's no recession. Exactly what we've been saying for 7-8 months now, and now it's doesn't feel so lonely.
Yeah, I couldn't agree more. When I did my outlook every year, I think I put out there to be at least a 20% gain at some point, from the beginning. I never know where a market's going to end in 12 months. I always think that's crazy. I don't know where it ends. But I felt there's going to be a 20% rally at some point. We obviously got that. So you and I were definitely outliers at that point. And, not well liked in social media. They just say, you rose-colored glasses. You don't see what's really going on. No recession. We've both been right on that. But I agree. I can't agree more. Last week we started saying, what, maybe we don't sell because it's such long term, right? If our whole period was 5 years, I'm not selling for a 4 to 6% pullback. But that being said, let's be a little conservative next couple of weeks because, you and I both look at charts. I felt like just the eye test that the major indices were so extended versus the trend lines versus the moving averages, even without looking at numbers. Did that catch you all just to see how far they've gone?
Absolutely. I mean, just how far above a 200-day moving average it was. Last week, 89% of stocks in the S&P were above their 50-day moving average. Now, I want to be very clear. When you get super overbought like that, that's bullish, longer term, but short term can be a little headache. Not to mention S&P up 5 months in a row. Now, here's the real kicker. You look back in history, I think it's 28 times. 28 times S&P's up 5 months in a row. It was up the next month like 75% of the time. So it can go to 6. But here's the thing you need to know. We're going to have a down month eventually, but a year later, the S&P has been higher 26 out of 28 times after a 5-month win streak with, I think it's 12.5% average return a year later. So pretty good size outperformance. So again, these are the stats and the figures I'd point out. Believe me, you don't want to take just any one of them by themselves. When you stack them on top of each other, I still see a pretty strong market. Final comment here. We've liked small caps and mid caps. Now, I know after the regional bank crisis, they pulled back. We are overweight those in the models we run for our Carson partners on the Carson Investor Research Team. And small caps, Russell 2's right at 2 major previous peaks, right? So again, maybe you have a little consolidation, little break, but we like small and mids over large. We still like those cyclicals, your industrials and energy are the two groups who are overweight. We're even weight materials and financials. We still think by end of the year, maybe that baton is being passed from large cap or large cap tech, I should say, and into some of those cyclicals as the realization there's no recession. Maybe now this is the final comment. Just before we came on, productivity came in way better than expected. Labor costs came in way lower than expected. Just everything we see from the economy, for the most part, continues to surprise to the upside. All these economists are scratching their head why. Bottom line, again, is consumers are really strong. It's still a strong labor market, and that can really pull things higher from the macro point of view.
I want to get back to the breadth. You talked about the 5 months and 89% above 50-day moving average. But before we go jump back there, just what your last comment about the consumer. And I've been making this comment. I've been in our home office in Baltimore here all week. The last 3 months in Nicaragua. So I just got back to the States and just seeing, I think what I read, the little news that I do read when I'm outside the country, but obviously, economic news I read, you would think that things were really getting bad. From what I read. And I get back here and every airport line's packed. I can't get a coffee in the morning at the airport because the line's out the door. You can't get a seat at the bar to have a beer before I get my evening flight. I just booked a flight this morning for today to fly down to Florida on Southwest, mind you, not first class, $550 one-way ticket. I mean, and people are paying this, Ryan. So is this not just a simple eye test, smell test, whatever you're going to call it, that the consumer's okay?
Yeah, I'll tell you, here's what really hammered it home for me, Matt. And I'm being sort of funny, but not really. In November, I tried to buy Taylor Swift tickets for my daughter. And it became very clear to me that if Taylor Swift is having this tour later this summer and people are breaking Ticketmaster because they're all trying to buy them, then they're selling for thousands of dollars. I've got a podcast, Facts versus Feelings. We talked in November about this, saying, listen, how in the world are we going to have a recession when you've got a rolling Super Bowl out there every weekend? And of course, it's kind of playful, but maybe not. I mean, I bought 6 tickets. I did make taken. I sold 4 of them for
Wow.
$10,000. Are you kidding me? $10,000? But that's what people were paying for these. That doesn't sound like, now maybe Swifties have a lot more money than everybody. Maybe someone needs to break that up. But I mean, that's just one way to look at it. But I mean, that's a good way to look at it. And like you said, I mean, late last year, travel in the country like I get to do and talk to our advisors. Yeah, everything was packed. And believe me, things aren't perfect. I mean, manufacturing was in a recession. Yeah. Maybe you could argue still kind of. Housing was in a depression. I think both of those were headwinds last year, going to be more tailwinds. Think of this, Matt. Housing detracted from GDP 9 quarters in a row. I'm pretty sure that's like an all-time record. If it's not, it's really darn close. We're going to start to see housing add to GDP going forward. Manufacturing, here's this really unique situation. You look at surveys, right? How many people talk about the ISM surveys or the LEI from the conference board? These have a lot of surveys in them. Everybody's feeling bad. But if you look at the real data that comes out, construction and construction spending, a lot of these things, it's like booming. We have a manufacturing revival in this country. No one's talking about it because you have the CHIPS Act and the Inflation Reduction Act, which really doesn't do with inflation, more to get the economy going. There are some really positive things on the real data, the hard data versus soft data. I can't explain it. Maybe it's social media, maybe whatever it is, but the hard data is what we side with, and it continues to say this economy is way better than people think. Last comment, consumer confidence has been really low. It's starting to finally creep higher. Honest to goodness, you can almost inversely relate consumer confidence with the price of gas. And gas might start to go higher a little bit. We kind of like energy and oil to go higher here. But nonetheless, consumer confidence is coming back, which is still a positive thing in our view.
So there's about 4 things I want to pull out of that. But are you a Swiftie? Would you consider yourself a Swiftie?
I would say no, but here's the catch, and there's always a catch, right? As a strategist, we always talk out of both sides of our mouths at all times. I listen to Taylor Swift every morning because I drive my 15-year-old daughter to school, drive her to it's summertime, so not school, but a cheerleading practice and stuff. So I might know every Taylor Swift. And here's the real kicker: are you a true Swiftie if you know like all of her 19 different boyfriends and which boyfriend the song's about? Okay, literally, my daughter yelled at me yesterday, Matt. True story. She was, which one's this about? I'm like, blah, blah, blah. And she's like, no, it's about this one. So I'm trying to learn which song's about the boyfriend. That's a true Swiftie, my friend. Yeah.
I got to tell you, you're father of the year right there. I'll give you that. You talked about manufacturing, Ryan, and it's kind of off topic we were talking about, but that's a great point. We do our monthly newsletter and put out this for more of a larger cap. So we just recommended a stock actually yesterday, after the bell yesterday, and it's manufacturing/automation. And, obviously breaking down the big trend, my team, I mean, the numbers like you talked about with manufacturing and the productivity that's increasing with more automation, lack of people out there to fill these jobs. That being said, I think we're in a renaissance of manufacturing next 10 years. I think that the manufacturing facility today and versus 10 years from now could be night and day, all automated, almost looking like white rooms. Just think about what that brings to the economy. And that's kind of how I'm viewing that.
No, I love that because in let's say World War II times, 40s, 50s, we were a manufacturing economy. I think about 40% of our economy is manufacturing. Now it's like 12 to 14%. But back then you had to stop and shut down, lay people off. We're going to be so lean. And I'm not saying a recession's coming. I'm saying if one did, the way that we can manage a recession now versus 30, 40, 50, 60, 70 years ago from a manufacturing point of view is clearly night and day. Industrials are like one of the strongest groups, right? Industrials have a big part of manufacturing, as most of us know. Look what Caterpillar just said, earlier this week. I mean, it's hard to think industrials be at an all-time monthly closing high last month, it's a couple days ago, if this big, global recession that a lot of people have been telling us about for the longest time was truly coming. I grew up in the camp that the market is smarter than all of us. You don't have to agree with the market, but you sure better side with it. And to see the leadership that we're seeing from industrials and materials all of a sudden, I mean, those are things that say there's no recession coming. I mean, yeah, the yield curve's inverted. Yeah, LEIs for 14, 15 months in a row been negative year over year. There are other factors you better be looking at or you've missed so much of this rally. And unfortunately, a lot of people have.
So how do you combat the argument then, play devil's advocate from the bears and say, through the first 6 months of the year, 98% or whatever, 95% of the gain in the NASDAQ 100 was driven by the Magnificent Seven. Obviously we all know who that is. We'll have to break that down. But what is the argument to that? Because you also said earlier that 89% of S&P companies are above their 50-day moving average now. So those two things don't make quite sense to me, how they both can be acting like that.
No, they don't. And we've been in the camp that it's way more. I think it was for a while, it was 5 stocks. And all of a sudden they made it magnificent 7. But nonetheless, just a few stocks create. And most years are that way. Okay. Most years, your big winners win. I mean, Michael Jordan scored a lot of points for the Bulls. They still got their championships. I mean, I don't know why that's a bad thing. But again, there's a lot. I mean, materials make up, I believe, 2% of the S&P 500. You can have a big move of materials. It's not going to do much. It's not going to move the dial versus Apple, which is worth like more than all the material stocks in the world, right? I mean, so I think that's something important to note. I mean, literally January this year, there was a surge with like a whole bunch of stocks beneath their 10-day moving average and then above their 10-day moving average in a short time frame. I forget the exact numbers, Matt. But we started talking then that this is a major breadth move that we saw. We saw so many of these major breadth moves with all these stocks going up. Yes, if you look at the point percentage, the big ones counted more. But to say that, only a few stocks are going up is totally false. So we wrote about that and I talked about that. Last comment, I like to look at advanced decline lines. How many stocks going up versus down? We've been seeing either 52-week highs or all-time highs across the board in the advanced decline lines for a while. The Dow AD line broke out earlier this summer. Breadth leads price is how I learned it, suggesting new all-time highs were coming sometime, in the near-term, intermediate future, likely on the Dow, and Dow's not that far away. And maybe I have a little sell-off here for some seasonal weakness, but still, all in all, new highs are probably coming, and breadth has been telling us that for quite a while.
And the breadth, to me, as you mentioned, could be negative, and I hate to even use the word negative. It could be maybe some headwinds in the near term, right? When I say near term, I mean for a few weeks or a month. But longer term, it's a huge tailwind because it's showing that a large majority of that index is moving higher, if I'm not mistaken.
No, that's how I look at it. Absolutely. I mean, and honestly, let's talk about something else here. So that's breadth, right? You want the leadership, but we're getting the good leadership. At least we have lately. Here's what I want to see. Well, if I were to turn more cautious, here's what I'd want to see. Utilities, staples, real estate start to lead on a relative strength basis. They continue to lag. Now, maybe they're going up, right? They're going up like all sectors, at least as of last week, were higher for the year. After this week, maybe not. But, nonetheless, you're getting the right leadership. The weak stuff or the more defensive stuff is lagging on a relative basis, and that's what I want to see. Well, here's one more. We just went 47 days, Matt, on the S&P without a 1% drop. That was a heck of a run on the upside. That's normally how bull markets work. You don't have too many 1% swings up or down. So I took a look. That's more than 2 months, okay? 47 trading days is more than 2 months. If you look at it, it's like 21, 22 trading days a month. I found, here, this is wild, 27 times since 1980, we went at least 2 months without a 1% drop. What happens after that 1% drop, Matt? 1 year later, S&P up 26 out of those 27 times after that first 1% drop. So just to say, wow, we went a while without a 1% drop. Here it is. Let's sell everything. No. Now, I will also be very clear. 1 in 3 months, we've had a good deal of red, especially lately. So maybe it fits in that theme you and I talked about earlier that maybe a little, indigestion makes sense. But to blindly say, let's sell because we had a 1% drop. No, history would say, not so much. Any weakness, you probably want to be a buyer, which is what we've been saying for a while on the Carson investment research team.
So maybe we tell everybody, go actually take that August vacation, enjoy your friends and family, and come back in September. And there's probably a good chance you may have a couple percentage pullback in stocks you're looking to buy. And you probably stay away from your portfolio so you don't freak out and sell something now that's pulling back. And I think that's the biggest mistake that people make. It's not avoiding buying in a pullbacks. It's freaking out because, if the market's down 1% and you have a high leverage company, it may have been down 4% yesterday, but it's probably up 45% for the year. It's okay.
Exactly. Eisenhower said plans are useless, but planning is everything. I like to use that. I get to talk to a lot of clients all over the country doing client events for our advisors. And I can't tell you, Matt, how many people talk about, I sold in 2008. I sold in 2002. I sold after the pandemic. And then they miss these rallies. They're like, what can I do? It's like, well, you sold at the wrong time. And it's unfortunate what happens with so many investors, but they need to have that plan in place. If you like a particular stock out there, you say, listen, when that stock drops $50, $100, whatever it is, I'm going to buy it. I'm going to almost promise you, we live in the world of fiduciary. We can't make promises. I'm going to almost make a promise here that when it happens, you're going to turn TV on. You're going to see some well-known bear talking about the end of the world coming, and you're not going to want to pull the trigger. That's why you have to have that plan in place ahead of time, because I get to go on TV all the time. I don't know why. They've been throwing me on TV a lot lately, probably because we've been right. People are noticing, which is nice. But, I'm trying to explain. Yeah, I'm trying to explain some of these things that have the plan in place ahead of time. It's easy to say. Believe me, everybody, you care about your family and your money more than anything. So when those two things are or one of those things are not working, or both aren't, you're going to make bad decisions. It's how our brains are wired. But to have that plan written down in place, and that's why I would say you should use a financial advisor or someone like yourself, someone who can help you, understand what's going on, not to panic. I mean, literally the day of the lows in October, Matt, we had that 5% swing. If you remember, we had CPI, terrible number, down 2%, finished up 2%, more than a 5% swing from lows to high. We mentioned that very day at our team. I did on Twitter. Go find it. I think October 13th, 14th, around then. The people hated the idea that, listen, 6 of the last 17 bear markets ended in October. This is a non-recessionary bear market. Those usually bottom around 24%. This one was just 25%. And talk about negative sentiment. Everybody thought the world was going to end, and I didn't feel very comfortable either. It was a very scary time last October. But it happened. And then we had that rally. And in November, we went on record saying, that's it. That's the low. That was the October low. You had your standard midterm year October low. People hated that call. But it's obviously worked out well. And being overweight equities has worked out well. We still think it's the way to go. Just be aware, maybe it could be a little choppy here.
Yeah, but it goes, what you just said, I've been saying for literally over a decade, giving these speeches, talking to advisors or individual investors or just the average person. You show them a stock where, say it's Amazon, Tesla app, something that's done well, or NVIDIA. They say if NVIDIA pulls back to 350, I'm backing up that truck, right? NVIDIA gets to 350, they're scared to death. There's no way in hell. They'd feel more comfortable if it rallied back to 450 and bought it at 450 versus 350. That's just, they can't comprehend it. It's a human brain, for some odd reason, refuses to take something on sale. You're given a gift on sale and you refuse to buy it.
Well, two things there. Lawrence of Arabia, remember that show? There's a candle, and the big guy takes his finger at the candle and pinches out the candle, doesn't react. The other guy says, I'm going to try that. He tries it. He screams in pain. And he's like, how in the world did you do that? The first guy said, you just got to know it's going to hurt. That's investing. It's going to hurt at certain times. You've got to know it going in. I like to use that story. The other one is they say the stock market's the only place things go on sale, but everyone runs out of the stores screaming. Most of the time things go on sale. Exactly. You want to go buy it, right? You want to go buy, I want some shoes. I want that basketball. My kids need this. I need that. You need $300 tickets to Florida, not $500 tickets to Florida. We're going to buy it when it's on sale. The stock market's the only place where a stock that was 500 now is 300. You don't want to touch it. You loved it at 500. You don't want to touch it at 300 for the most part. And believe me, we can get into psychology a lot more, and you've had a lot of good guests talk about that. But that's how our brains are wired. And we just have to kind of rethink that, retrain ourselves, or work with other smart people to kind of make sure you're not making a bad decision at the absolute worst time, which is what I've seen in my career talking to so many investors, unfortunately.
Yeah, I would say, the biggest thing that I offered to my clients, having my RIA for 17 years, was protecting them from themselves. A lot of people can pick good stocks. A lot of people can invest in indexes. That's not a genius. That's doing hard work and making sure you're in the right position, but not freaking out when a flash crash happened 15 years ago, not freaking out when the pandemic, like all this stuff of keeping them sane, not buying meme stocks, all the stuff that people make huge mistakes on, keeping them away from that. But speaking of kind of some big things moving now, we had a downgrade of the United States yesterday. And I saw you put out some work on that. Any big picture thoughts first? Did that freak you out when you saw it? Did it change your big picture view at all?
Yeah, no is the short answer. I mean, I guess the initial reaction was, why now? I mean, honest to goodness, Matt, the stuff they were listing.
Mine too.
Concerns about the government, concerns about debt, concerns about a slowdown. I mean, you could have made these comments anytime the last year, 2, 3. I don't know. I mean, you could have done these for a while. So I love what Jamie Dimon said. I mean, Jamie Dimon, I think most of us think maybe that guy should run for president. Just the way he explains it. Go listen to what he said. I mean, he said, literally there are countries that are rated higher than us that are under our protection of our military. Does that make a lot of sense? Like that Jamie Dimon said, not me, that's Jamie Dimon. But it's like, wow, that's a good point. I mean, it didn't make sense. I mean, put it this way. When the first one happened in 2011 in August, the S&P dropped, you ready for this? 6.66. 666. We dropped over 1% yesterday. Now, I'm not even sure if that's why, because you look at futures yesterday, that ADP number, stronger jobs number, maybe a couple earnings weren't so great. Yields just don't want to go down. They're sniffing out something going on there. I mean, all these things factored. I don't think we dropped because of the debt downgrade. I don't think the debt downgrade is going to matter that much. I mean, we still have the world's reserve currency in dollar. The Treasury, maybe it's not AAA rated according to Fitch anymore, but if we know that what hits the fan, people are going to come to our treasuries and our dollar. I still feel very confident saying that. So there's more to get into it, but honestly, Matt, I think it's just using an excuse. maybe for some people to sell here at these levels, and we don't anticipate it being any big deal. Final comment. From the first downgrade, the S&P's gained 275%. All right. A lot of bad stuff has happened. 100-year pandemic, inflation, deflation, all that stuff's happened. But still, 275% gain. Now, I get it. It wasn't an easy ride. So let's just not panic right here with this debt downgrade as of now.
Good. I think that's the best advice out there. I mean, first thing I heard, I was like, am I reading this old news? Did this come out a couple months ago and I just missed it and somebody regurgitated it? It's like, it doesn't make much sense. And I know DC is not very happy about it. I don't care what happens to DC, but they're not very happy about it. But yeah, I agree. Big picture, I don't see this. It's more of a non-event and kind of a headline. You mentioned real quick there, we always talk equities when we have you on there, but you mentioned yields going up, and the 10-year yesterday did hit the highest level, I think, since mid-November of last year, up around 4.1% or so now, and give or take. Do you guys do a lot of work with that or how it relates to equities?
Yeah, we do. I mean, plain and simple, historically, a higher trending 10-year yield has not been bearish for equities. It's normally been bullish for equities, right? And again, I think it's the market sniffing out this economy continues to be strong. Yes, the Fed is likely done hiking, our opinion. Just the inflation data we got this morning continues to say that. But again, I think it's just sniffing out a strong economy. And what tends to do well when yields are going higher, right? I mean, it's some of your value names, right? Your cyclical value names. I mean, now I get it. Tech has had an incredible run. Although lately it's hit some air pockets, so it's never as simple as that. But I think it still suggests to us, and we've been overweight equities, underweight fixed income, right? We've shortened up our duration of fixed income models we run for our partners and our advisors. Bottom line, again, is that's kind of where things have been. I mean, remember, crazy to think we were talking about the Fed, cutting rates, back in March and April. We didn't buy that one, and the market's obviously saying that as well. The just thought of me with Congress, I think is a joke is another one. If the opposite of pro is con, the opposite of progress is Congress. There you go. That's another good one.
That's very true. Yeah, we don't count on them for that. But yeah, I look at the yields and you look at TLT, which tracks 20 plus year Treasury bonds. Breaking down to the lowest level since November. And there's a lot of investors out there, Ryan, that are still very squeamish, hesitant of equities, and they think, okay, I'm going to lock in, the yield, whatever TLT is paying right now. Don't realize they're actually losing money going to TLT because the capital depreciation of the value of the ETF that they're in. So it's not only that you're kind of the opportunity cost of not being in stocks and actually losing money going on the opposite direction, being overweight bonds, which I know a lot of large financial advisors are. Over 4 trillion or so is in money markets still. Even if that gets down to 3 trillion, don't you think that 2 trillion at some point? And it's going to happen, obviously, after the market breaks out, in my opinion. You'll start having a FOMO and chasing it. But, boy, that's a hell of a tailwind for the markets, in my opinion, when that does happen.
Agreed. I mean, it's cliche to say cash on the sidelines. I mean, turn on CNBC. Yeah. Someone will talk about it. I probably use the phrase, too, so I'm probably just as guilty. But $5.5 trillion in money markets is a little bit of cash on the sidelines. So I'm with you. Eventually, I'll probably move into equities as people realize. And let's not forget, 7-8 months ago, you can make 5%. You make for sure 5% after literally the worst year for like 60-40 portfolios ever, with bonds down double digits, stocks down double digits for the first time ever. That 5% sounded really good to a lot of people. And sure enough, here we are, S&P up over 20%, at least it was before the sell-off on a total return. Bonds haven't done that great, but up a little bit, I guess. So it's just, it's unique how psychology works there.
So before I let you go, I asked you this last show, and I can't remember what you said. I'm sure my producer could tell me, but I always do the old island question. I put you, your daughter, Taylor Swift on an island for 10 years. And then, just kidding. The whole family, and take Taylor Swift with you for 10 years.
Okay.
And so what's the one investment? It doesn't have to be an individual stock. It could be a sector. It could be an index. It could be a theme. But is there something that after the rally that we've had that you still feel comfortable for next 10 years?
Yeah, small caps. I mean, I like small caps a good deal here. So large caps have had this incredible rally. If you look at, I'm not a huge valuations guy, but I'll look at them. I mean, small caps are historically like decades cheap relative to large. We think some of these major themes and changes that could take place of small caps, if you want to have a 10 year horizon, I think will do a good deal better than large caps. So I'm going to ask you, how are your Eagles looking? What about your Eagles this year?
I got to tell you, I think they're the second favorite to win the Super Bowl behind the Chiefs. I think they look great. The problem is As a Philadelphia fan, I'm not quite sure you know many Philadelphia fans. When life is good and things actually look good, we tend to be very pessimistic and think the worst. So I just keep thinking Jalen Hurts. Every morning I wake up, he's going to get hurt. Something's going to happen. But apparently A.J. Brown looks like the best receiver in the league right now, and everything looks good. But yeah, I mean, I know you woke up to that a couple of weeks ago with your quarterback and Joe Burrow.
Yeah, I mean, I was literally, you're gonna love this. I was in Kansas City. Look, we're not fans. We don't like each other. Kansas City Bengals have created a good rivalry, which is fun for football to kind of have two teams that really don't like each other, which is cool. Anyway, I'm in Kansas City. My phone starts blowing up. I'm like, if Burrow just tore his Achilles in Kansas City, I'm never coming back to the city. Fortunately, it doesn't sound like it tore his Achilles, but you're right. It's anyway, it'll be fun. But I mean, I thought there were some questionable calls in the AFC Championship game. I think you guys got hosed in the Super Bowl, but it is what it is. Let's hope things even out next year with the Zebras. I'll just put it that way.
Like I said, I think we said this last time. If it's the Eagles in Cincinnati, we're going. Yeah. I'll meet you there at some point. I will be at the Super Bowl to do that.
It's in Vegas. Pretty sure it's Vegas this year, I think.
I think so too, which means I'm limited to 2 days there. I'm only allowed 2 days, so I have to get out of there. So.
Yeah, I did a bachelor party once. I did a bachelor party once for 3 days in New Orleans. We said that's 1 day too many. It's 1 day too many. You got to stick to 2 days in these big cities like that.
2 days and get out in the big cities. Exactly. And it goes like that. But hey, listen, thank you so much for coming on as always. Again, please everybody follow him on Twitter. Ryan's one of the must go tos every morning for me. So please, you'll educate yourself just by doing that and probably help your portfolio quite a bit as well. So Ryan, we'll have you back on soon. Thank you so much. And again, you're not going to have Park. You've been right on since the last time we had you on, and I think you're going to be right on here again. So thanks for joining us, and we'll talk to you soon.
Thank you.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.